Back to you.
Okay, I like the way how Hormuz, was trying to bring the good rather than the bad in front of us. Thanks a lot. I think some mood enhancers always a good thing, especially at a time like this. I also want to look at the electric vehicle related stocks, the EV component suppliers. So there is Sona BLW, there's Uno Minda. Nomura has put out a note where they've said that EV component suppliers like Sona and Uno Minda will be key beneficiaries of the government's continued focus on electrification. There's a new scheme that was launched by the Ministry of Heavy Industries. It's called Electric Mobility Promotion Scheme. Now, this is to support electric two-wheelers, three-wheelers and e-rickshaws. This is, of course, the CNBC-TV18 News break, so that has been confirmed. The only thing is the incentives for electric two-wheelers has been reduced to 10,000 rupees from 22,500 earlier. But a couple of my analyst friends tell me that this was something that was expected, the incentives to go down. The fact is that the government continues to push electrification, which is positive.
Absolutely. Right on cue, Sonia, the market opening on your screens. And I think we've got, 21,943 coming up on the Nifty. Those are the first rates, and the Sensex is coming up with some red as well, about 180 odd points, 187 points. So 72 points lower on the Nifty and 185 points lower on the Sensex are the first rates. Straight away to mid-caps and small caps. Mid-cap index is down about 1%, 573, 600 points lower on the mid-cap index. And the small cap, which of course has been the bigger pain point, and that index was down 5 yesterday. The small cap index is down about 1% as well. So a weaker start. We'll see, but these are the first rates. But more with Sonia. She's standing by. Sonia.
Well, thanks a lot for that. I think the important number is right there, right? The BSE declining number, which is 1,124 stocks on the declining side and just 420 on the advancing side. So that goes to show you that the market breadth is very, very weak at the moment, and at least at the start of trade. Let's see how it goes from here. I also want to once again pull up the small cap index and the mid cap index. There you have the mid cap index down almost 500 points over there, down over 1%. And the Nifty small cap index here is down 1.5%. So not looking good as far as the opening for the market is concerned, which is the broader markets. Straight to individual stocks then. Tata Motors has signed an MOU with the Tamil Nadu government for setting up vehicle manufacturing facility in the state, so that is positive. I also want to see what's happening with HDFC Bank, because there is this FTSE rebalancing on the 15th, which could lead to more flows coming into HDFC Bank. And this is important. While the market is down quite a bit, the HDFC Bank stock is down only 0.3%. So clearly there is a degree of outperformance that we're seeing. Also, delivery buying has picked up in HDFC Bank in the last couple of days, so keep an eye out on that. Coal India, Nigel was talking about that a while back, so it would be interesting to see it. Look at that, outperforming the market. Jefferies has a buy call with a target price of 530 on Coal India, so it's looking pretty good over there. Cholamandalam Finance, Jefferies has a buy call on that stock as well. They have a target price of 1400 on the stock, which is a big upside to the current market price, so there's an outperformance there. Chola Finance is the one I'm talking about. IIFL Finance, on the other hand, more downgrades coming through after what happened in the recent past. HSBC has downgraded it to a reduce with a target cut to 340 from 790. But, it's already at 385, so there is perhaps some more to go on the downside. A couple of more stock action in terms of news flow. Godrej Properties has bought a 3-acre land in Hyderabad. The booking value potential is 1,300 crores. JSW Energy has bagged a letter of intent from Solar Energy Corporation for 700 megawatts connected solar capacity. Kalpatru Power Projects has bagged an order worth 2,445 crores. HAL has bagged an order worth 8,000 crores for 34 advanced light helicopters. And I want to look at the EV stocks once again. You have Sona BLW, you have Uno Minda. These would be the key beneficiaries of the government's continued focus on electrification as per a Nomura report. But otherwise for the market, I think the Nifty Bank is feeling the heat now, down almost about 380 odd points. While the Nifty is holding steady, it's the broader markets which continue to be under pressure. Back to you.
All right, Sonia, thanks a lot for that. By the way, Nimesh's standout brokerage report on IPCA, that one is flying away. That's up close to around 5%. So clearly the street taking note of that one. Hindustan Copper as well as up close to around 3.5%. It's corrected from around 300 rupees to around 235 rupees yesterday. But copper prices were up overnight, as Manisha told us. So that's why that stock, in fact, is up close to around 3.5%. Mahanagar Gas has seen a sharp correction in the last few days, but that's opened up in the green. It's up close to around 3% from around 1,500 rupees, went down all the way to around 1,200 rupees. But that one is higher in today's trading session. What else is moving around? Well, I just want to point out two key aspects for the Nifty to hold up. One is Reliance Industries. That, at least for starters, it's come out in support of the bulls. The 50 DMA, as I mentioned earlier, that's the one I'm tracking. 2,845 is the mark you should be looking at on the downside. For the time being, it's well above that mark. The Nifty Bank is the other one. That as well, the 50 DMA is extremely crucial and it's almost at the 50 DMA. So you want to keep an eye out on that one. If you pull up a chart, you'll see that the Nifty Bank, well, it's around those levels. So that's another important one. Coal India, biggest gainer on the Nifty, reacting to the Jefferies report. On the flip side, the fairest stocks are a little bit nervous. Tata Steel, JSW Steel, both of them down to around 2.5%. In the broader markets, well, they're getting pummeled yet again. Let's see whether or not intraday we do see some kind of bite.
All right. Well, let's just look at the broader market then, right? So IPL, that is the petrochemical chemicals company, that's down 8. It's coming up as the largest volume-led loser today. So 232 on that one, and it's not as if it's been a big outperformer or anything of that sort either. I mean, it's done well, but nothing compared to what some of the others have done. Suzlon is down 5%, large cut there. Stocks had in large volumes as well, but a 5% cut. Inox Wind is down 5%. So both Suzlon and Inox are down 5 each. So that's the wind power companies. Tata Investment Corp is down another 5%. This one, of course, a huge, still sitting on humongous gains. SW Solar is down another 5%, just under 500, 489 or so on SW Solar. Walkhard is down 5%. These are all daily limit down, right? I think. Schneider is down 5%. So many names. But, again, KPI Green is down 5. Webull Solar is down about 5%. Spark is down 5%. Gensol is down 5. Gensol, of course, I think the high was about 1,400 or so, recent high. And from those levels, it's basically almost half now, 788 on Gensol. So yeah, that's the list of what's coming up with some losses. Market breadth is negative, but it's not nothing like yesterday. But this is also just the start. So we'll see how things pan out. On the upside, apart from what we've already mentioned, Railtel is up 4%. It's the biggest number one volume-led gainer. Hindustan Copper is up 4%, and Nigel and Manisha were talking about the copper price rally that we saw. Adani Energy Solutions is up 4%. The Adani Group stocks all sold off, right? Yesterday, I can spot Adani Energy Solutions and Adani Total, which are up about 3.5%. MGL is up 3%. Action Construction is up 6%. So there is some signs of life on the upside as well in the broader space, which are coming through.
Even in the frontliners, right? The interesting part is that the market is finding some, solace in individual stocks. So look at all the large caps. There's L&T, there's Infosys, there is, of course, Coal India because of that brokerage report. There's Reliance. There's definitely buying action that's coming in. I understand that, a lot of investors speak about how they were patient for 1 year and their gains have been eroded in one day. So that pain is there. That pain is separate. True. But right now in the market, you are seeing some signs of buying interest in large caps.
Well, I think in the next couple of days, you could see some kind of a bounce back as well for the markets. As you were mentioning, Sonia, earlier today, the advanced tax, that'll be out of the way, which is a bit of a hindrance. And also that's a March phenomena, tax harvesting as well as advanced tax. So that'll slowly get out of the way. Then we'll have to look at pockets where there is a lot of froth. They'll continue to remain under pressure. But select stocks will do well. And for the time being, the breadth of the market actually has improved. We have more than 1,000 stocks that are advancing right now. And if we can end with 1,000 stocks advancing, I'll tell you what, the bulls will party today. Because yesterday, there were only 100 stocks that advanced on the Nifty itself. When you had one of those 100 stocks in your portfolio, you would be very happy.
Well, we'll see. But yeah, it's turning, right? Almost 1:1
Getting
in terms
closer.
of the advanced decline ratio. That's what's coming through. Harsha Upadhyay is with us, President and Chief Investment Officer at Kotak Mahindra Asset Management Company. Harsha, good to have you with us here. You guys have been advocating caution for some time now. And I guess yesterday would have been one of those days where you could have picked up the phone and said, well, we told you so. But the question now is, and you and your team would be scanning for opportunities because you guys are sitting on cash as well. With this 13-14% fall in the small cap index, have stocks that you want to buy fallen? 25, because there's this list of stocks going around where stocks have fallen, 25, 30, 35%. The question though is, are those the names that you want to buy? Quality names, or you think these were frothier names which went up, which are giving back gains, but and not really the list of names or the kind of names that you'd want to be in? Just give us a sense, Harsha.
Good morning, Prashant. Clearly, we are still not deploying all the money that we have at our disposal. Not that we create active cash in our portfolios. However, we do have some limited cash in our small cap strategy, for example. But at this point of time, probably wherever we are seeing excesses is the pocket that is correcting more than the overall market. So to that extent, some of the names that we like on a fundamental basis are yet to reach those levels where we could probably deploy all of this cash. Anyways, we never do that at one go. We generally take a little bit of time in terms of analyzing the markets and valuations and conditions, everything. So over the next few days, we'll keep watching and we'll take a call on that. But as of now, we don't think that it's corrected enough for us to really go ahead and deploy.
You, Harsha, net buyers yesterday? Unfair question. X blocks, etc. Was Kotak Mutual Fund a net buyer yesterday?
I don't remember the exact numbers, but I mean, every day we'll be buying something, we'll be selling something, but I don't think we bought only because of the correction that we have seen yesterday. That would be my answer.
Okay, by the way, guys, look at the green on the screen, right? The mid-cap index is flying now. It's up almost 0.7%. It's up 330 odd points. And it could be very volatile. And there's no two ways about that. It's not that the worst is over, but it's just that for now, the mid-cap index is seeing plenty of buying action and a lot of names, right, in the broader markets. I mean, whether it's something like a JSW Infra, Olectra Green Tech, you have, if you just sort by larger markets or non-index large caps, you'll see there's a lot of buying. Adani Group stocks are seeing buying interest as well. Redington is up about 4%. Well, some bit of green on the screen. Harsha, hi, good morning. You know, retail sentiment has been hit very hard, right, in the last couple of days. I mean, portfolios have been smashed out of shape. What is your advice to that retail investor who has waited patiently for 1 year, built on to his gains, and now is seeing all of those gains get eroded in the matter of a week? What's your advice to them, given that you've seen so many such cycles?
Sonia, I don't think India growth story is impacted at this point of time. Economic growth continues to be very strong. Corporate fundamentals continue to be strong. The only issue with the market was the high valuations, and especially in the names where there was not sufficient liquidity or where the fundamentals were not really supportive. One should continue to remain careful even after this correction, I would say. But if your portfolio is well diversified and if it is based on the fundamental strength of those businesses, then these corrections are also part of the overall market movements, and you will be able to wade through this volatility. But just make sure that your portfolio is diversified and you are making a staggered and disciplined investments rather than putting in all eggs in one basket.
Indeed. Hi, Harsha. Good morning. Before I ask you my next question, I just wanted to pull up a few stocks that have bounced up by close to 10% from the day's low. I'll just request my director to pull some of these stocks up. IRFC, you pull up the intraday chart out there. The stock was down close to 5%. Big bounce from the lows. SJVN, well, that one as well is up close to 11% from the low point of the day. So the intraday charts come up for you. Hoodco is the other one that got slammed yesterday. That stock as well is coming up. And these stocks are coming up on very, very large volumes, as well as IRCON. So some of these stocks are bouncing back. We'll have to see how long can they sustain. And the Nifty Bank, by the way, if you could get that 50 DMA with the Nifty Bank up for you, it visited the 50 DMA, and from there, the Nifty Bank has seen a bit of a bounce. And I think that's going to be a crucial trigger for today's trading session because it's taken support out there and it's moved up as well. And Reliance Industries is batting for the Bulls. That's what I'm talking about. The 50 DMA, it touched it, and now, in fact, it's moved a little bit above those levels. Hi, Harsha. Good morning, and good to see you in as always. Harsha, we have some news in terms of the auto stocks today with regard to that EV push. There's a bit of an extension, though some part of that subsidy has been cut down. What's your view on the auto space on the whole? And if you have a view on this EV theme, because it generated a lot of excitement in the uptrend. And now, in fact, maybe in the next 4 months or so, we don't know whether that'll get extended. And the subsidy as well is getting pulled back. So some of that excitement could be fizzling out. Your take?
Nigel, on the EV part, I think still the jury is out in terms of what's going to happen. Not just the subsidy cut, but also there is a question mark whether EV technology is going to be superior or hydrogen technology, which is more viable, or the hybrid in between. So to that extent, I think only over the next few years, we'll have a clear answer in terms of how this space is going to shape up. But clearly, I think IC engines are going to make way for something newer technology, that's for sure. But it's going to be a gradual change over the next few years. As far as auto companies are concerned, especially two-wheelers and the passenger vehicle manufacturers have been seeing reasonably strong demand, and that has continued into 2024 as well. So within autos, these are the two subsegments where we have been positive on. Tractors have been weak, and even commercial vehicles of late have turned weak. So those are the two pockets where we would probably be a little more cautious going ahead as well until we see signs of recovery in demand.
You mentioned that there is no problem with the India growth story. It is only valuations that were concerning the street, and now some of that froth is coming off, right? Fair enough. But going forward, do you think that this could be a period of protracted pain for the market? That once the price correction stops, we could also get into a prolonged period of time correction, and that could be a bit frustrating for investors. Is that a base case scenario for you?
Sonia, at this point of time, it's very difficult to predict how soon the correction is going to end or how soon market is going to start an uptrend. But clearly, the momentum is broken. The market breadth, as we have been seeing over the last couple of trading sessions, has turned really weak. And that shows that there is clearly nervousness across the market. Whenever you see such kind of a phenomenon, especially at the market tops, it doesn't come back immediately. So to that extent, I think first we'll have to see some stabilization in terms of the market levels, and then probably some consolidation, and then a next move. So to that extent, probably it's fair to say that we are unlikely to really pull back into newer highs immediately. But what's the time frame? It's really difficult to say.
By the way, market breadth is now almost 2:1, advanced decline ratio, as a signal, I mean, just to use, you don't buy the indices on small caps and large caps, small caps and mid caps, right? You buy individual stocks, but as an indication, we put out in the morning, the small cap daily RSI was about 24. Now that's very, very oversold, so maybe a bit of a bounce, etc. is possible. But I mean, it's all about stocks and what you own and what you don't own. Nigel was talking about IRFC, and just if there is any signaling effect, right, to take away from that. The top gainers are Railtel and Electra and Swan Energy and some of these names, right?
Who got pummeled yesterday.
Got pummeled yesterday. So Rico Auto, another one. Now we'll see, but this is still very, very early days in terms of what the opening looks like, and I think we'll see more changes. This is the first chapter of what will play out today. Harsha, in terms of themes and sort of opportunities, etc. What are you guys really looking at? I mean, let's just talk about hospitals for a bit, right? Quality healthcare is a real need, and hospitals have made so much investment. Everyone is expanding. But there was some news flow recently which took stocks down even before this mid-cap, small-cap fall, 10-15%. I think they're still there, available a little lower. Have you looked at that space closely, taken a call, sort of acted in any which way?
Prashant, not in the recent times, but we do have a couple of positions in our portfolios, and we continue to remain positive on the overall theme from a medium to long-term perspective. Yes, in the recent times, we have heard some issues in terms of capping of prices and how that's going to impact profitability or even the capacity expansion going forward, etc. So yes, in the very short term, probably this will remain as an overhang until we see a clear trend in terms of what's likely to happen on the regulatory front. However, it's very clear that healthcare needs in the country are increasing, and there are only a few listed entities who are really in a position to really expand the hospital network. So to that extent, it's going to remain a clear theme from a longer term perspective. But yes, there will be intermittent hiccups and corrections along the way.
What about city gas companies, Harsha? Again, another spot where some regulatory noise took prices sharply lower. Any thoughts?
Prashant, I couldn't hear you completely. Can you please?
City gas companies, city gas distribution companies, IGL, MGL.
Yes, again, this space has seen some of those news recurring every now and then. And to that extent, I think on the same news, we have seen stocks falling many a times in the recent times. So overall, this looks more or less at the bottom, given the high return ratios and how our volume growth is likely to continue on a secular way for this particular set of companies. We are positive on this space overall in many of our portfolios.
Okay. Well, for now, the market is, the Midcap index is rising, but it's also getting very volatile. In the last 10-15 minutes, it has been all over the place. In the broader markets, you'd also want to look at some of these real estate stocks because, the rally has been pretty fast and swift, and now there is a sell-off that's coming through as well. So Prestige Estates, you have a couple of others. Phoenix Mills in that, ancillary space is also down. Some of the hotel stocks, Chalet Hotels is down about 3%. Brigade Enterprises is down 2.5%. DB Realty is down about 2%. So in the list of volume-led losers, I'm noticing a lot of real estate companies. Harsha, what do you do here in real estate? Because, the going has been good, the demand has picked up, but stocks have also rallied a lot. At some point, do you look to buy the dip or do you stay away entirely?
Sonia, clearly this is again one of the themes which will probably be very strong over the next few years. We have not seen any excesses in terms of inventory coming into the market. In fact, it's been the other way around where demand continues to be very, very strong, hardly any inventory left in the system. And most of the established players have cleaned up their books and have also started to grow in a reasonable manner. So overall, looks an interesting space. But again, like many other spaces, this has also moved up quite substantially over the last few quarters. So to that extent, we would probably wait for the valuations to correct a little more.
All right, Harsha, final question before we let you go. Then, cement. There was this big theme that we're getting to in an election. There's going to be a push for construction. Real estate as a segment was doing quite well. But suddenly, there's been some fizzling off of that optimism. Volumes are fairly okay. I've done quite a few checks out there. The problem is on pricing. And they're not able to push through those price increases. And with some input costs cooling off, they're not being given that reason as well. How do you view the cement stocks from here on?
On cement, we continue to remain positive. While there has not been price hikes, as you mentioned, the raw material prices or the input costs have gone down. So to that extent, profitability is likely to look better even with flattish prices, I would say. And demand continues to be very strong. And the projections for near-term demand are also very, very strong. So we continue to like this theme, even at this level.
Okay, all right. Harsha, we'll leave it there. Good speaking with you and appreciate you joining in with that perspective. Thanks indeed. That's Harsha Upadhyay with the perspective on markets. Of course, Kotak Mutual Fund has been sort of warning some caution for the last few months that broader markets perhaps were getting a little overdone. So the pullback has come through. Markets, by the way, is blinking red and green now. There was a sharp recovery from the day's low. And now we've gone into flat terrain. So 21,000, just under 22,000, basically unchanged from yesterday, 330. But broader market, 2:1 is the market breadth, which has come through. Well, let's just play out some opinion that we got. This is veteran banker Uday Kotak, who essentially commented on markets and whether we are in some sort of frothy zone, risky territory, etc. This was, of course, he's speaking at the SEBI the NISM research conference. He did acknowledge that maybe there was some froth in certain areas, but things were not under control. Listen in.
That I believe at this stage, we are nowhere near that risk. And there are enough checks and balances in our system today to compare ourselves in serious bubble territory. There may be early froth, as if I can use the phrase from what you said a few days ago. But I would say that it is still froth, little bubbly, but not out of control.
Okay, that's the word coming in from Uday Kotak. But one person who has been talking about the possibility of, a market fall is Prashant Khemka of White Oak. He's someone who, in the past as well, has spoken of a little bit of caution in the system. Listen into what he had to say after the recent fall that we've seen.
If you look at over the last 12 to 24 months, or even I would say somewhat longer post-COVID, it's been somewhat of a one-way street. And equity markets, so there was this some overconfidence setting in amongst investors, particularly as it relates to small cap names. Small caps, despite the 10-11% downtick that we've seen over the last few weeks since the high that was reached earlier this year, it's still up 60+% from March of last year. Yeah, at its peak, it was up 80 or nearly about 80%. So there was a considerable amount of excess that has been built into certain segments of small caps. And so it's a timely, I think, I would say even an awaited correction.
Of Kotak Mahindra AMC added that this correction in the market is an unwinding of excesses. Take a look.
So one thing I can reassure everyone, the stress tests are not going to give any cause for this correction. If we see last 1 year, it was 1-2 ka 3 market. The large caps delivered about 33% return. Mid and small cap delivered about 61 and 69% return. And micro caps delivered about 93% return. So this is the unwinding of the excesses rather than, the stress test of mutual fund. It is stress test of leveraged retail investors.
Okay, it's a stress test of investors, not so much the companies and SMEs. But anyway, for the market, it's still very quiet. It's flat, the Sensex and the Nifty. The Midcap index is the one that's seeing a recovery. So that's a good thing. After yesterday's carnage, there is no incremental pressure, which is, I think, a great thing from a market standpoint. But let's see how the rest of the day goes. For now, our focus is on Adani stocks. They have been under pressure. One stock we are focusing on now is Adani Wilmar, which is down 7% this week so far. Their 9 months FY24 volumes were at 8%, while the total inventory stood at 7,000 crores. To discuss how is the demand situation, how is business momentum, we have Anshu Malik, the MD and CEO of Adani Wilmar, who's joining us now. Anshu, thanks a lot for joining in. As I mentioned, sir, in the 9 months of this year, in FY24, the volume growth was about 8%. So it's still in single digits. And in Q3, the volume was flat. Has demand come off quite a bit? Are you, worried that perhaps there could be a bit more of a slowdown before things pick up? What is your best guess of how the next couple of months could look like? And what is the volume growth that you're targeting for FY25?
See, the first 2 quarters were not so good, but the last quarter, this quarter, we are seeing good growth in terms of volume. We expect for the first time the branded edible oil business will have a double-digit growth, possibly after 4-5 years. The country is seeing higher consumption of edible oil. As a result, the overall business of edible oil has improved in terms of volume. Prices are low, so the consumptions are higher. Q4 should be also equally good in terms of volume growth. Going forward, the country is likely to consume more edible oil because in the stable prices. We see this consumption overall continuing at this. At least FY25 might be a little better than FY24.
Okay, so you said double-digit growth is what you're looking at for FY25, correct?
Yes, in edible oil for us.
In edible oil, okay. And can you tell me about the pricing situation? How is it right now? What is the expectation going forward?
See, the prices has been quite stable all through the last 4-5 months. Only its last 15-20 days that the prices have gone up. That is because of the supply side constraints, particularly shipments not arriving on time. But these are all logistic issues, which I think by 15th of April, it should calm down. So looking forward, the supply chain should be normal as usual. And country has also produced good mustard crop. And so that will add from next week or so after Holi. So the supply chain will be very good.
All right. Hi, Mr. Malik. Good morning. Nigel on this side. And you're sounding quite optimistic on business. So that's always a good thing to hear. Well, what about your market share? How do you see it panning out from here on?
This year, the market share has increased by almost 75 to 100 basis points. That is mainly because of our in-depth distribution, both in urban and rural. We have increased our number of dealers in the rural market. And today, surely our direct reach is more than 700,000 retail outlets. Indirect is around 2.1 million. So we are the largest distributed edible oil in the country, branded.
Yes.
So I think going forward, we should continue to do better.
All right, so you've increased market share by 75 to 100 basis points, which is good news. You want to give us an updated number, though? We have some numbers flashing on the screen, which is the overall and the branded business.
We should close at refined oil consumer pack. We should close around 19%, or maybe 19.1 by March. Next year, we are targeting a little higher, and we hope to do that.
Okay. All right.
So branded market share, sir, you're saying is around 19.5%, right?
19% at least. 18.9 we were there last month, so I think March end should be better.
And your overall market share would be how much? Because the numbers that we have is 12 and 20%. So I ask.
20% when you look at is roughly around the refined oil consumer price that we look at. But when it comes to mustard oil, we are the largest player in mustard oil, which is around 14.8%. So that makes us the largest branded edible oil player.
Okay, largest branded edible oil player. Got it. I also want to talk about the food and FMCG business. Over there, in 9 months of this year, you've seen a growth of 19%. So that's not bad. But tell me, how is the demand situation there, and what is the growth target that you're looking at for FY25?
See, the domestic growth has been, I would say, very good. We have been clocking at around 25-30%. What has not done well is the export of rice, particularly white rice and broken rice, which we did last year very well. So that has brought down the overall growth to 19%. Otherwise, domestic, if you see, rice is growing at around 45 to 50%. Wheat flour, we are doing at around 30-35%. Pulses also, we are growing at more than 25%. So the domestic consumption is quite robust, both urban and rural. And I would say here that our rural business is also doing well in terms of food and FMCG, because these are essential products and required at every household. So the in-depth distribution in smaller towns have helped us gain that market share also.
So would you want to grow this business further in terms of an overall percentage of your business? Currently, the food and FMCG business is just 10%. Over the next 3 to 4 years, how much do you want to take that up to?
See, you are right. We are pushing our food business. We are investing in food business. And there are a lot of capex that is coming up, both from the IPO side and from outside IPO also. And we feel the food and FMCG business should grow. Today, it's almost 10% of the volume, but going forward, it should be in the range of 15 to 18%. We will do around 900,000 tons this year, but next year we are planning to cross at least 1.2 million tons. So food business should grow fast. There is a lot of scope because the branded food, particularly the staples, when you look at sugar, spice, sugar, and then pulses and wheat, flour, rice, their branded ratio is smaller. So there is a lot of opportunity to grow and ramp it up.
Okay, all right. Mr. Malik, what about margins? How do they pan out from here on? Give us a broad range that we should work with.
See, the margins have improved with stable prices. The brand has started doing well. There is a lot of premiumization that is happening. So earlier, our mass brands were selling more. Now, the Fortune brand is selling more. And there we have more margins. And going forward, I think the margin will improve. Number one. Two, as the volume increases, cost per ton reduces in distribution. And that is where we will have advantage. Processing cost goes down. Buying ability to buy at a lower price or at a discount price increases when the volume goes up. So overall, it looks like as the volume goes up in food and FMCG, and particularly when it is staples, it gives you quite a strong power to buy at a little better prices.
Okay, so from 3.9% of the past quarter, which has gradually improved, given the operating leverage, given the better mix that you're talking about, what should we work with? Around 4 to 5% or more for the coming year?
Can't say exactly how it is, but I can tell you one thing, that things are much better. It is improving. And whatever was past, surely we will be doing better. And that is an indication. Margins are also going to improve. With less volatility, the brands perform better. So we feel that the margins will improve going forward.
So the direction you have given us, that margins will improve. Final question from my end before we let you go. Adani and Wilmar, both of them hold roughly around 44.5 to around 44% stake, in the company. So you need to comply with that minimum public shareholding. How do you bring that down? Will you all be looking at a QIP? Which partner is going to be paring down their stake. If you could give us a broad timeline and a brief idea.
See, we have diluted so far 12%, and we need to do another 13%. And we have to do that by February. So obviously, we are working on it. We are looking at all the options. And we'll see how we can dilute the balance 13% and make the best out of it.
Okay, all right. We'll leave it there, sir. Thank you very much for joining us. And it's a pleasure having you here on CNBC-TV18. Good luck. Speak with you soon again. We'll take a quick commercial break here. We'll come back. We'll get you an exclusive conversation with one of Bank of America's top investment banking heads. Raj Balakrishnan is going to be joining us on the other side. Lots to talk about in just a bit from now. Welcome back. The market, on the Nifty is still blinking red and green, nothing at all, but advanced decline has moved aggressively into the green. So almost 3:1 in favor of advances. So welcome relief as compared to what we've had over the last few trading sessions now. Let's talk about the other big story, right, which is strategic investors, PEs, long-term investors selling in many companies here. We've seen that trend for the last 1.5 years or so. Actually, since January of 2023, promoters, PEs, large shareholders have sold some $21 billion and have raised $100+ billion through debt issuances. Let's talk about this in some more detail. We're now joined by we have Raj Balakrishnan, Managing Director and co-head Investment Banking at Bank of America. Raj, great to have you with us here. Good morning. Thanks very much for your time. I want to, of course, first of all, say congratulations. You guys were one of the two bankers in the ITC deal which happened. And it was a long-standing overhang. Some of it is gone. But can we say it is gone with regards to ITC? Because BAT still owns about 25%. So what could be the roadmap ahead? If you can share, because you would have been in touch with both sides, what's the thought process really? Should one watch out for buyback announcements?
BAT has put out a public release saying that they intend to hold their 25.5% stake for the foreseeable future. So I don't think I can say anything more than that.
Okay. All right. No, fair enough. But, okay, let's just talk about the reason then, right? It's not just ITC. We've had announcements come through from Timken. We had Whirlpool earlier. Could you talk to us about what is the underlying motivation for many of these stake sales? We actually had the Whirlpool global CEO come out and say in so many words that it just is a valuation arbitrage. Sell stock here in India and buy the parent company stock, which is available much cheaper. Do you think that is a primary driver?
India businesses of many multinationals are growing very, very rapidly. And as a result, I think the Indian market rightly, in my view, rewards these companies with extremely high multiples. Now, very often, this underlying value of the Indian business is not reflected fully in the value of the parent stock. And so from that perspective, for, as a corporate finance practitioner, it makes immense sense for some of these multinationals to evaluate monetizing part of the stake in the India business and using that for as a tool for funding their operations or opportunities in other parts of the world, whether it's buybacks or other investments that they wish to make. So from that perspective, I think it makes immense sense and reflects the coming of age of the Indian market. And I think people are willing to take a call that, as long as, for example, if you're between 51 and 75%, it does not really make a difference in terms of control. You're a listed company, you have a majority. Or if you're between 25 and 50%, once again, does not make a difference in terms of control. So from that perspective, taking some chips off the table does seem to make sense.
Raj, is there any signaling effect from some of these actions for local investors, or there is none? That, sort of large owners are...
I think it's just reflective of the difference in the growth opportunities between the Indian market and what you're seeing elsewhere in the world. The fact is that I think everyone is very positive about India, about the trajectory of the Indian economy, the fact that, and I think our markets very clearly reflect that in terms of the multiples, which price in probably sustained high teens to maybe even 20s growth over the next decade or two. When the same is not reflected in the parent stock price, it makes sense for people to take some money off the table.
Okay. Raj, hi, good morning. I have many questions for you. But first, just to finish the loop on this one, right? Does this also mean, because it was a large deal that took place, $2 billion, and it just speaks about the volumes in the market, the appetite, and it also speaks about the depth of the Indian market. Would you concur that the depth of the market is improving, and that is perhaps a positive signal as well?
No, I agree fully. And I think, to see a $2 billion trade, this is the third largest ever block deal in the Indian market. And it got executed in the block trade window, which is, at a less than 1% discount. So it's the largest ever deal in the block trade window. Last year, we had done a $400 million trade in the block trade window and felt very proud of that. And now we've been able to execute a trade which was 5 times as large. So certainly reflects the coming of age of the Indian market, as I said.
Absolutely. Just one more follow-up. Since you've been tracking this, you've been in this M&A ecosystem for so many years. What we're noticing now in spaces like pharmaceuticals is that there are a few MNCs that are looking to exit India. How do you read the kind of M&A trends, particularly in the pharmaceutical space?
I don't know if people are looking to exit India. I think once again, just about any company at every point in time takes appropriate decisions in terms of what is the focus area. So you could have a company, for example, which decides that their focus area is, if you're talking about the pharma sector, for a multinational, they might decide that the focus area that they have is on patented medicines. And very often those are, in the case of Indian subsidiaries, and 100% owned Indian subsidiaries. And they might decide, some of the older generic brands that exist in their Indian listed entities are no longer a focus area. So people might evaluate the possibility of trying to see what's the kind of valuation they would get should they wish to exit that. But I don't see a generic trend that multinationals are looking to exit India. I think what people are trying to do is optimize their portfolios from a strategic perspective.
All right. Hi, Raj. Good morning, and good to hear your thoughts. Nigel on this side. Well, I wanted to ask you about the consolidation trends. We've seen in media there's been some consolidation that took place, and that was long awaited. How do you see trends shaping up? Case in point being maybe the cement space. We've been hearing about consolidation. We've seen a fair bit of action, and that could be more in store. Your take?
No, I agree. I think in just about, the Indian market presents tremendous opportunities. And I think what we've also seen is, let's say 10 or 15 years ago, virtually every trade you thought of was an Indian selling and a multinational buying. But with the coming of age of Indian companies and the availability of capital that exists for Indian companies, now you're seeing a number of trades where you have Indians buying or private equity sponsors buying, and in some cases multinational selling, in some other cases Indians strategic selling. So I think it reflects, the M&A market in India today is no longer unidimensional, but is multidimensional, with each and every company taking calls based on their own strategy and portfolio choices in terms of what they want to do.
Raj, just a little bit of here and now. Do you think with a little bit of shakeout we've seen in broader markets, the pace of sort of QIPs and IPOs perhaps will slow down a little bit? Ps and VCs, etc., may continue to sort of monetize as we've been seeing. Would you agree with that?
No, I would disagree with that. I actually think that, for example, last year, we saw a large number of IPOs, but they were relatively small IPOs. So the total amount of funds raised through IPOs was relatively low. We had only 4 trades last year of more than $300 million. On the other hand, I think this year is going to see many more larger IPOs. And I would expect the total funds raised through IPOs this year to be significantly more than last year. Similarly, in terms of QIPs, last year was a great year for QIPs as well as for block trades. And I think I continue to see that trend continuing this year.
A lot of it obviously is also underlying market conditions, right? So in a way, Raj, you're also sort of saying that we should move past this current phase of volatility and a bit of drawdown that we've seen.
Yeah, I think you'll focus excessively on what's happened in the last 3 days or last week. Frankly speaking, if you look at the Indian market, be it on a 3-month basis or 1-year basis or 5-year basis or 10-year basis, it's delivered returns superior to virtually every market in the world. Even on a dollar-adjusted basis over the last decade, barring the US market, we are probably the best performing market in the world. So the fact is that the Indian economy is looking good, Indian markets are looking good. And, a phase of, if there's a correction for a week or 2 or even a couple of months, I don't think that changes the underlying trend.
No, I completely agree. But we also talk excessively about the short term because we talk every day. So there is that element to it. But we also, I can assure you, talk about the longer term returns. And we do that. That point about, actually over a 20-year period, I think the returns absolutely stand out compared to the rest of the globe. Just on that second part of my question, do you think this PE and VCs selling, we've kind of reached a bit of a high and it should taper off from here? Or what's the pipeline looking? Because you would have a bird's eye view.
If you just look at, the sheer volume of investment over the last 5 years from the PE and VC community in India, it has been tremendous, right? Several $1 billion of investment coming into India every year. And as you know, a number of these funds have a defined life and look to exit, say, in a 4 to 6 year kind of time frame. So I do think you will see several examples where investors look to realize the gains that they've made and return money to their principals or LPs. But at the same time, I think you will see newer PE and VC funds looking to make fresh investments in India. So this is part of the natural trend in markets. So I would not see that as either positive or negative for India. The fact is that at this point in time, for virtually any PE fund, India is a key focus area. And just because they realize investments that they made 4 or 5 years ago, it does not mean they're not going to make investments from the fresh funds that they have raised more recently and deploy them significantly in India.
All right, we'll let you go on that note. Thanks a lot for joining in and giving us your perspective on all the M&A activity that has happened in the market. in the last many weeks and months. But by the way, the market is breathing a sigh of relief for sure. So today what's happened up until now is that the headline index has been steady, no real selling pressure. In fact, there's been recovery. So the dips have been bought both in the Nifty as well as in the broader markets. Just look at the mid-caps. Mid-caps are up 330 points. Now, we're not saying that the worst is over, but just that for now, things have sort of quietened down a bit, which is what we perhaps needed after the carnage that we saw yesterday. Mitesh Thakkar is joining in now for a quick tech check. Mitesh, how are you feeling about the market? Do you think the rest of the day could also move quietly like this? And what are the stocks that you're looking at?
So, my sense is that the structure is weak, but with the kind of fall we had yesterday, I think, a partial covering of that big candle is possible. That, the very standard way of a intraday pullback playing out after a big declining or a red candle day. So maybe, you might see levels of around 22,100, in the best case scenario, even 22,200. I would be mentally opposed to it, but I think at 22,100, 200, I think that zone could be tested, but the structure is weak. So we'll maintain a negative bias. Only on some stocks, I had a buy on ICICI Pru today. I think that's turned positive. Only on some stocks where you have long-term comfort, I think, where the long-term charts are very good, will suggest a long. So one of them is Pidilite, which I would suggest buying with a stop below 2,800 for targets of 2,900. And I have a sell call as well because the structure to me, I think, is weak. So we'll suggest a sell on Shriram Finance. Keep a stop about 23.30, which is just around the day's high, and look for targets below 2,200.
Okay, all right, Mitesh, thanks a lot for that. Well, the markets have seen a good bounce from the day's low, and some of the stocks are really taking off. One such stock is Ipca Laboratories. It's buzzing in trade. Nimesh had highlighted the stock in a special segment, D Street, brokerage reports. He's joining in to fill us in with more on that. Nimesh, I think I'm so eager to hear your D Street chatter later today that I'm getting carried away because I missed it yesterday. But tell us about Ipca Laboratories.
Well, on Ipca Laboratories, there is an upgrade coming in from HSBC. So today they've upgraded the stock to buy with a target price of 13.35 versus 11.25 earlier. Now, HSBC believes that Ipca can see a notable improvement in margin expansion on the back of healthy growth in focus markets, which is India and UK, as well as easing cost pressures. Now, they are building in an EBITDA improvement of nearly 470 basis points and a PAT CAGR of 50% for FY24 to FY26 estimates. And they believe that the start to the US supplies could be the next big trigger for Ipca to do well from here. On the risk side, they foresee a couple of risks. One, continued weakness in the slowdown in the India market, and two, adverse development in the global markets, which includes the currency depreciation as well as supply chain disruption. So, while they see some risk, but the risk reward is favorable according to HSBC, and hence a buy on Ipca Labs an upgrade in Ipca Labs to buy now with a target price of 13.55.
Okay, Nimesh, thanks a lot for that. So that was the standout brokerage report and big up move coming in on Ipca Labs. Let's take a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Do stay tuned in. Welcome back. As promised, let's get Manisha Gupta to tell us about what's happening in the commodity markets. Manisha, what are you tracking today?
Well, Sonia, I'm looking at copper and Dr. Copper. I want to call it that because finally we're looking at a lot of support coming for this one. You know, for all these months, equity markets were doing well, but not copper. But we are finally looking at LME copper now trading at a 7-month highs above $8,800 a ton. If you look at the New York copper prices, those are trading at a 16-month highs, and the Chinese copper prices are trading the best at almost 24-month highs. So every time zone that you look at in globally for copper prices is trading at a multi-month highs for these markets there. Well, the support really comes in quite strong on a week-on-week basis. If you look at copper prices, we're up by 4%, and it's 8% up in the last 1 month as well. The copper inventories is like an interesting number to watch out for. When you look at the Chinese copper inventories, well, it has jumped up quite strongly. We started the year with 30,000, and we are looking at 230,000 tons of copper inventories right now. But on LME, it's quite a reversal, really, because we started the year on a weaker note, a stronger note rather, and we've seen nearly 30% of a decline come in for the copper inventories on the LME markets. So there is some online warrants that markets have seen onto this one. Now, most interestingly, and this is the point to watch out for, 15 Chinese smelters have agreed, and this is a rare one really. They've come jointly and they have said that they will cut production due to losses there. Now, TC/RC charges, when you look at that, have continued to decline as well. If you look at the overall smelting that Jan and Feb have seen, it has been 11.5% of a decline onto this one. So much of this has been inactive. Various reports have already suggested that. And processing fees for copper in China and global markets has continued to decline. It's at a decade lows. I actually want to take you through those charts as well. So when you look at the latest numbers that have come in sense of TC, it's as low as $3 to $8 a ton at this point in time. On 1st of March, it was at $12, 19 in Feb. November, that is when the prices got decided. For all of this year, it was decided at $80 a ton, which was already lower than 2023 on what they saw at 87. So from 80 of a decision, we're trading at $3 to $8 a ton in sense of TC charges, and the markets are scared that it could go to zero, and is the reason you have seen all of those smelters come together and talk about cutting production. Now, this tells you that the near-term tightness is something that is supporting copper, and if the smelters do not work, then from concentrate to copper cathode is something that you will see tightness come in for as well. The other thing is Codelco, where the production also has continued to decline. There are mine disruptions as well, so copper clearly in favor at this point in time. And experts tell us that from these levels as well, 8 to 10% of an increase in next 3 months is what you should be ready for.
Right, Manisha, thanks very much for that. We'll take a quick commercial break here. We put the spotlight on regulatory actions and governance on financials. We'll connect with Abizar Devanji, who of course heads that practice at EY India. We also have Mr. S.S. Mundra, former Deputy Governor, Reserve Bank of India. Anand Sinha, former Deputy Governor, RBI, is also going to be with us. Stay tuned, that conversation up next. Okay, welcome back. Markets bounced from the day's lowest point and, of course, doing quite okay now. Broader markets are doing even better because that's essentially where the problem and pain has been. Market breadth is looking positive. Now, regulatory action and governance on financials are in the spotlight today. A bunch of actions have come through recently. And to discuss all of this, we have Abhizar Divanji of EY India and two former Deputy RBI governors, Anand Sinha and Mr. S.S. Mundra. Gentlemen, great to have all of you here. Appreciate your time. Mr. Mundra, if you can start by asking you, sir, on something that we reported. This is, of course, source-based information, but my colleague Sapna from Delhi reported that the government is asking PSU banks to review gold loans. They essentially are saying that there are instances of non-compliance of regulatory norms as specified by the regulator, by the government. So just wanted your thoughts on this one, sir, to begin and kick this off.
Sorry. I think I have little connectivity instability. I missed your question. I'll try to switch to another. Meanwhile, can you start somewhere else?
Yes.
I'll just try to correct you. Yeah, please.
Okay.
Please.
Okay. We'll do that while you sort of come back with us. Let's actually bring in Mr. Anand, who's with us, Mr. Sinha, who's with us as well. Mr. Sinha, same question to you if you want to respond. The government looking at gold loans by PSU banks pretty closely now. This is, of course, sources sources to CNBC-TV18. Companies we've spoken with, I mean, traditional old gold loan companies like Muthoot in the private sector have told us that public sector banks coming in the space has raised competitive intensity in a very large way. This is the feedback which has been there for the last year and a half or so now. How would you look at this, sir, in the context of sort of, general, regulatory and compliance-related measures which have increased over the last 1 month or so? Go on, sir.
See, as far as gold loans are concerned, there have been some problems in the NBFC sector, gold loan companies, we are aware of that. Now, in the case of public sector banks, what exactly is the concern? I'm not aware of, but one thing I can say from a regulatory and supervisory perspective, that when any portfolio expands at a rapid pace, it's a red flag for regulators because invariably a large expansion and a fast expansion is accompanied with weaknesses developing in control systems. So could be that could be a concern. And exactly what is the concern now? As I said, I really don't know. But if the portfolio is expanding rapidly, then certainly it becomes a matter of concern. It does not mean necessarily that things are wrong, but it certainly means that one should have a look on the control systems, on the appraisal processes, on loan sanctions, and ensure that the system is fit to deal with this kind of expansion.
No, I mean, the pace of expansion of gold loan portfolio has been very, very fast, right? But I mean, for many of these PSU banks, the base relative to their own balance sheet size was small, but now, of course, it's become much bigger. Some of the aspects which we've been told is banks have been asking to fix anomalies with respect to gold loan disbursement without collateral, with respect to collection of fee, interest, closure of gold loan accounts, etc., and also with respect to repayment in cash. These are some of the specific points, Mr. Sinha, which the RBI is talking about. Mr. Mundra, if I can bring you into the conversation. Mr. Sinha telling us that when a particular segment grows very fast, it is usually accompanied by things which are left out, things which are not done properly, and the regulator steps in and takes a closer look. Your response, sir?
Yeah. So, first, of course, I'll pick up from where Mr. Sinha left. That is true. And it's simple, I am not going to a particular segment, but even if you take at the industry level, you see, if you take last 3-4 years, the average credit growth in the system was around 15%, whereas the growth in unsecured loans was on the side of plus 30%. So I think that is one itself is a very broad indicator that certain segments need to be relooked into. Coming to specific, whether it is gold loan or it is any other action which is taken, from whatever I see and hear so far, let me put it like this. I don't think that it was at the governance level that thing would have gone wrong or indication would have gone wrong, but it is certainly a reflection of lack of control. And I can speak from both the perspective, the practitioner's perspective and regulator's perspective. When I say more control, see what happens ultimately in an organization, then there are certain units are there which are operating at the ground level, then there are targets, and always, there would be a communication and pressure to meet the target. And in the process, at operational level, I think many of the controls which should have been exercised, they are allowed to be relaxed. And then things come to this level. By the time they are noticed, sometimes it is, in a very initial stage and you can control them. Sometimes it has become quite big. So at that point of time, even if regulator is asking them to correct them and giving a deadline, actually in practice, it becomes very difficult. So you will see both the things. Regulator, see in all these cases, you would have seen that regulator has been engaging with the entities for quite some time. It's not a very sudden action, but despite that, things have not happened. And this is what at the ground level which contributes to this.
Got it. Let's get Abhizar Devanji into this conversation as well. Abhizar, a lot has happened, right, in the last fortnight. I mean, the RBI has come in and tightened the screws on several sectors, whether it's gold loan financing, whether it's loan against shares, whether it's IPO financing. Which are the other segments that you think could be vulnerable from here on? And what are the implications of all of this regulatory action?
So firstly, I think to answer your question, Sonia, which are the aspects that can still be covered? I think the larger concern is end use of loans not being known. So gold loans or personal loans, one doesn't really know where the money actually lands up. Does it land up in consumption or aspirational consumption? Does it land up in the stock markets? Does it land up in repaying other loans which are otherwise being delinquent? One doesn't know. So I think the bigger issue is going to be anywhere where end use is not clearly defined is an area where a regulator will have a concern. So I think that is the primary issue. Now, if you, just continuing with what the other two the two RBI deputy governors have said, the real issue that we have on hand is the changing business model of banks. Banks have tended more towards retail and within retail towards, unsecured or where the ultimate end use is not known. Now, banks have also tended towards that. And by the way, by tending towards that, they've entered into an NBFC category. What happens when they enter into an NBFC category is that the NBFCs who actually borrow from banks have to slide a little lower down the credit scale. When they slide down a little lower in the credit scale, then they have to accept cash, then they have to mend the customer, when they have to make sure that they make certain concessions, and that is where control breakages happen. So what is happening is that there's a shift in the business model that's been happening over time. And I think that is what is the RBI or the regulator, including SEBI, are trying to grapple with. One, where the money is going and what kind of credit is actually entering the system.
Okay. Do you agree to Mr. Mundra's point that the gold loan clampdown is actually not at a governance level? It may be a more proactive measure that the RBI is taking. I mean, particularly on gold loans, you mentioned that end use is a concern. Got that? I mean, not knowing the end use of that, that loan is a concern. But what else do you think could be the primary concern here? And how do you think the way forward would be on gold loans particularly?
No, so I agree with Mr. Mundra when he says that, these are more control-related issues where RBI is trying to preempt a potential bubble. And yes, there is concern. Obviously, every regulator will be concerned where there is a potential bubble building up, and we are seeing that, right? The stock markets have melted down over the last 2 days. What will be the implication of that on loan against shares? One doesn't know. So I think a clampdown is more a precursor, a worry that the central bank is looking at. It's not necessarily fraud, but it is process-related issues that they are going to be concerned about. So I think that's only thing is that the frequency of it is causing a little bit more of an alarm. Too many things happening too quickly is, I think, what is causing the panic.
In quick succession, right? The other thing which has happened is RBI halting fresh issue of co-branded cards at Federal Bank and South Indian Bank. Abhizar, you want to take that up? That also seems to be with regards to specific entities.
Yeah, again, I don't think these are specific entities. Everything, just look at it. They are fundamentally against co-branded cards. What RBI is saying is co-branded cards is what? It's basically outsourcing your core business. Somebody else is issuing a credit card the underlying belongs to somebody else, the customer belongs to somebody else, the bank is a booking vehicle. And when those kind of issues happen, then there is always a concern that is the bank exercising enough control to make sure that their credit is worthy. And the next step that they're expecting is that they will be overdue on credit card payments. And those overdue on credit cards is already happening, by the way. Overdue on credit card payments in the co-branded section hold a far bigger risk because the customer doesn't belong to the bank. And I think that is why it happens. And I don't think it's going to be specific. They've picked up two inspections, but it is again an area of concern that people have. Now again, I think the larger issue is the bigger bubble that's brewing up. And I was just chatting with one of these younger groups, and they were saying that we are more interested in aspirational lending now. So this whole concept of aspirational lending is actually scary, because the aspirational income may not be there for that particular segment. But if the aspirational borrowing happens, then there is a chance that there could be higher levels of delinquency.
You used the B word, bubble word. In what segment exactly? You said, you said the bigger thing which is brewing, yeah.
So, resources are like water. Once you push it into the system, it can just go anywhere, right? It can go to the stock market, it can go to the credit markets, it can go to real estate, it can go wherever. So which bubble? Difficult to say. But I think what is to be controlled is the resource distribution. And that is what I think the central bank is aiming at.
I think that's well put. Maybe we can say bubbly, not bubbly yet, but...
People are using words like frothy and bubbly and...
All right, we'll leave it there. We wanted to go on, but we're completely out of time. Abhizar, Mr. Mundra, Mr. Sinha, appreciate all of you joining us here on this quick chat today. Thank you very much for your time, and look forward to speaking with you soon again. By the way, I just want to leave with the small cap index, right? I mean, not the Nifty, not the mid cap, not the bank Nifty. The small cap index is up almost 2%, all right? And that's the rebound that we have on our hands already. Look at that. And steady kind of rise is what we've seen today. Market breadth is positive, almost 3:1. 600 down, 1800 up. So clean, neat 3:1 advances to decline ratio. The bank Nifty is slightly down about 1/3%. Otherwise, there's green on the screen. It's a wrap from all of us here. It's goodbye. Thanks for watching. Chartbusters up next.
The Indian markets get some respite after yesterday's sharp sell-off. The Nifty reclaims that 22,000 mark. The mid-cap and small-cap indices too trade with gains after a big sell-off in yesterday's trading session.
Federal Bank slips after RBI bars the fresh issue of the company's branded cards, with issues appearing to be specific of company's branded partners. The stock is lower with a cut of around 1.5%.
Ipca Labs rallies about 2.5% as we speak, 3% as HSBC has upgraded the stock to buy, raised the target price to 1335 rupees from 1125 rupees per share.
Traditional and Western snack maker Gopal Snacks has seen a weak debut on the exchanges, listed at a price of around 351 rupees a share, which is a 12% discount in comparison to its issue price. The stock, however, has recovered from the low point of the day. Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me today, as always, is Mangalam Malu. Well, Mangalam, we started off in the red. We've seen a good bounce off there. And, after a couple of days, we at least have two indices that are trading in the red and, two in the green. So good to see some green on the screen. And that 50 DMA has got defended on the Nifty. And the breadth of the market now nearing 2.5 stocks advancing for one stock that's declining. I think the bulls will be feeling quite good today.
Bulls will be feeling quite good today. Can I take the credit because of the green shirt and green tie? But no, having said that, Bulls will be happy that, the kind of carnage, for the lack of a better word, that we saw yesterday is not continuing today. The question is where it goes from here, because 22,000, yes, that's a mark that we've taken on, and 22,200 is the one where we have the 20-day moving average of the Nifty, whether we cross that or not. And in the latter part of today's trading session, we'll have the weekly options expiry play out on the frontline index as well. But one of the stocks on our radar is traditional and Western snack